Hello everybody, welcome to another video on the Technical Trade Sync YouTube channel. And today we're going to be talking about how politics affect companies and the stock market. You know, with Donald Trump entering into office now, felt like this would be a good time to cover this kind of stuff. So let's just get right into this one here. So we're going to be talking about how the economy has performed with Republicans or Democrats in office. So based on history, there's not a massive difference in stock returns, whether it's being run by Republicans or the Democratic Party. But a couple things to note here. So during election years, the S&P 500 has averaged an annual return of 11.57%. And then during non-election years, the average return was 12.35%. And this is dating back to 1926 through 2023. With 2024 being an election year, they don't have that information quite yet, but I'm sure that will be coming out in a little bit here. So non-election years, there is a slight bump up in returns, mostly just because of during election years, you're not really too sure what's going to be happening, if there's going to be a party change in house and stuff like that. So non-election years are a little bit higher for the average annual return, but not a huge difference. So during election years where the presidency stayed the same, the average annual return was 16%. And when the presidential party has switched, there's been an average annual return of only 6.35%. So quite a big drop off there, mostly due to a lot of uncertainty. And then the new president also just trying to get their agenda in place and sort things out. But with a Republican president, the average annual return was 9.32%. And then with a Democratic president, average annual return was up at 14.78%. So a bit of a difference there. So it'll be interesting to see how everything performs with Trump being Republican and him entering into the office. One other thing to note is that presidency doesn't directly control the economy as much as people think it does, but if you take presidency and Congress together, that definitely has a much bigger role than just one specific thing. We're going to be looking at divided versus unified governments, and this information is from Retirement Researcher. So during periods of a divided government, the S&P 500 has averaged an annual return of 10.18%, where periods of unified government saw a return of 14.14%. So slight bump up there, but with the Republicans controlling presidency and Congress being unified, their average annual return has been 14.52%. So numbers will probably be something similar to that, seeing as that is the current situation, but we'll see what happens. And then when it's a unified Democratic party, it's at 14.01%. And then this one was interesting for me when I found this out. Divided presidency and Congress with a Republican president, average annual return was 7.33%, and then a divided one with a Democratic president was up at 16.33%. So interesting numbers there. We'll see how things perform now with unified Republican presidency and Congress. So something to definitely be keeping an eye on moving forward here. Now, taking a look at some of the sectors that performed the best under Trump's previous tenure, there's a few of them, but something to keep in mind is that part of it was during COVID-19, the global pandemic, and this time around we don't have that, so I'm curious to see how these sectors perform this time around. So we'll start off with technology. Trump's admins were relatively hands-off regarding regulation, creating a favorable environment for tech growth. The sector saw heightened scrutiny in the latter half of his term, yet regulatory action remained limited. And I'm curious to see how the tech juggernauts perform this time around. You know, NVIDIA and Palantir, they've been absolutely skyrocketing over 2024. So Curious to see if that continues into 2025 and the years to come. And then the financial sector, Trump's administration implemented a rollback of some Dodd-Frank regulations, reducing compliance costs for banks and easing restrictions on lending. Additionally, the 2017 Tax Cuts and Jobs Act lowered the corporate tax rate, boosting profits for banks and financial services companies. So if Trump does decide to do some more cuts, that could be a good thing, and will definitely help the financial sector. Onto industrials. Trump's focus on infrastructure spending, defense contracts, and domestic manufacturing stimulated growth in the sector. Trade policies aimed at promoting America First manufacturing benefited some industrial companies, though tariffs on imports, particularly from China, created uncertainty and mixed results for multinational industries. Now, Trump has said that he is going to boost tariffs, potentially up to 25%, so it'll be very interesting to see what happens with imports and stuff like that. Onto the healthcare sector. Trump's push to lower drug prices created mixed impacts on pharmaceutical stocks, but overall the sector thrived due to advancements in medical technology, demographic trends, and a strong focus on vaccine production during the COVID-19 pandemic. As I mentioned before, we do not have a global pandemic going on right now, but that shouldn't stop the healthcare sector from performing well this time around with Trump in office. Onto consumer discretionary. E-commerce, home improvement, and streaming companies were amongst the strongest performers. Keep in mind this was during COVID, with checks coming from the government to help people handle the troubles of the pandemic. Amazon soared, while companies like Walmart and other storefronts took a massive hit, which that totally makes sense, seeing as nobody was really going out shopping and actually going into stores. Lots of the time it would be people ordering off of Amazon and other huge websites to get their needs instead of actually going into a store. So we have energy, and this is mostly pre-COVID. Trump's focus on energy independence, deregulation, and support for fossil fuel industries, rolling back environmental restrictions and promoting drilling. Initially boosted energy stocks. However, the sector was hit hard by the 2020 oil price crash caused by a drop in global demand due to the pandemic, again, severely impacting companies like ExxonMobil and Chevron. So hopefully this time around, there's not obviously a pandemic, so hopefully that will be good for the energy sector. Onto real estate. Trump's tax reforms, including changes to the treatment of real estate investments, benefited property developers and REITs. Low interest rates made borrowing cheaper, boosting construction and property purchases. So this is an interesting one because interest rates have been going up, and then on January 29th, they are going to be announcing the new interest rates. So definitely something that we'll be keeping an eye on in regards to real estate. Utilities delivered steady returns due to low interest rates and their reputation as a defensive sector. Trump's support for energy independence indirectly benefited utilities, particularly those relying on natural gas. Despite deregulation efforts, investor interest in clean energy utilities continued to grow due to the shift towards renewable energy. And then lastly, there's the communication services industry. So the increasing reliance on digital communication and entertainment during Trump's term fueled the growth of social media, streaming, and telecom giants. Tax cuts and a hands-off regulatory approach further supported profitability. Again, this was largely impacted due to COVID, with everybody being told to stay home and not gather into large groups. There was a massive spike in social media usage, streaming, telecommunications, and stuff like that. So we'll see how things go this time around, especially since there is no COVID-19 pandemic happening and people aren't being forced to stay home. And then what to do with this information. So based on this information, whichever party the president is a part of does not have a massive role into how the economy is going to perform. stick to an asset allocation model that works best for you in your current situation. And then lastly, investors should be aware that there's a lot of volatility in the year after the election. This is due to the new president being in office and trying to establish their agenda, which that totally makes sense. As I mentioned before, during election years, the average annual return is down from non-election years. So the first year afterwards, the president, they're just trying to get everything in place and trying to establish what they think is going to work. I'm curious to see what happens, and hopefully things do go in the right direction. Obviously, S&P 500 has been at the highest that it's ever been before, so there might be a slight dip just because that's how things go. Things go up and then they go back down. But all in all, I think the economy is going to still perform very well, even with the change in presidency, change in parties, and everything like that. So that is going to wrap up this video. Nice short one for you today, but just wanted to cover some of this information, seeing as Trump is going to be going into office here. So lots of things to look forward in the year to come, and hopefully you liked this video. Hopefully it gave you a little bit of a better insight into what to expect. That's going to wrap this one up. Hopefully you gained some knowledge from this. If you did, please like this video and subscribe. It really helps us make videos for this channel, and hopefully we will see you in the next one. Thank you.